Welcome back to Chapter 6. In the previous video, we looked at not only the general way of thinking about accounting for the selling of our inventory, but we also looked at one of the specific methods to figuring out what that inventory actually cost us. We looked at the specific identification method. We'll look at our final two methods in this video. Now, in both of these, both FIFO and LIFO, and we'll get to their specifics, you first want to figure out the cost of goods available for sale immediately prior to any of the sales transactions for that period, which is what we did in specific identification. Then you apply either FIFO or LIFO to figure out exactly what was the ending inventory and the cost of goods sold after the first sale in the sale transaction in the period, and then we repeat these steps. So then after the first sale in the period, we figure out what is the cost of goods available for sale now. We add in any additional purchases, and then we go to the next sales transaction. We figure out after that what is the ending inventory and the cost of goods sold, and we repeat until we have finished all of the transactions for that period. At the end of that, we will sum all of the cost of goods sold to get to the final cost of goods sold for the period. And we will take the final ending inventory amount for the final inventory transaction to come up with final ending inventory. Let's first look at FIFO. And we do actually say FIFO. This is first in, first out. This actually follows inventory units in an unbroken stream. It actually follows the costs, rather, not the units themselves. The costs enter and leave inventory in their order. So you sort of imagine each grouping of inventory sort of standing in line and waiting its turn to come into the inventory account and to leave the inventory account. The earliest purchases, the first in purchases, are assumed to be the first sold. So first in, first out. Thus, the most recent purchases are what will be left in ending inventory. Though the FIFO method is following the costs, not the units specifically, which is what we did in specific identification, it is the closest to mimicking a specific identification method. It is the closest to simulating the physical flow of goods in a company. So let's look at an example. Cornerstone 6.5 goes back and looks at Tampico Beachwear and their Crocs shoes. Once again, they begin the month of October with 300 units in inventory at $16 a unit. Remember, step 1 says compute the cost of goods available for sale immediately prior to the first sale. All right, well, let's figure out when is that first sale. First sale is on October 8th. So what is the cost of goods available for sale just prior to October 8th? Well, the cost of goods available for sale will be the beginning inventory value, plus, in this case, any purchases before October 8th, which is just one, which is purchase number 1. Beginning inventory was valued at $4,800. The value of purchase 1, which was 600 units at $18 a unit, was $10,800. So this means that the cost of goods available for sale just prior to the first sale was $15,600. Now, we'll move on and we'll figure out, gee, what happened when we sold the first group of shoes on October 8th? Well, it's first in, first out. What were the first shoes in inventory to start October? It was the 300 units at $16 a unit. Would that have completed the entire amount needed for sale 1? Nope. Because they needed 800 to sell, and that would have only given us 300 pairs. So they would have had to take another 500 pairs out of the group of inventory that cost $18 a pair, right? Well, let's look at how we actually think about this. Generally speaking, we try to create a chart or a table to figure out our inventory. So on October 3rd, we already know that the total amount available for sale as of October 3rd was the $15,600 because they had this amount plus the $10,800 that they purchased on October 3rd. Then on October 8th is when we have the sale. We know that first in, first out says we would have grabbed those 300 units from the first in grouping. They're $16 a unit, so that means $4,800 of value was sold right then. Then we know that it was a sale for 800 units, right? So 800 units minus the 300 we've already sold means I need another 500 units to sell. 500 units, where am I going to go to get them? Well, I'm going to go from the next inventory group down. Remember, it's first in, first out, so I'm going to go to the next one down, the next most recent, and they're at $18 a unit. 500 units times $18 a unit gets me $9,000. So that first sales transaction was $4,800, if you can read the writing. $4,800 plus $9,000 gets me $13,800. So now figure out what was left in ending inventory. Do I have anything left of this first grouping? Nope, I've sold them all. So there's nothing left there. And then how much do I have left of the second grouping? Well, I had 600 in there, but I just sold 500 of them. So there's 100 units left. And it's 100 units times $18 a unit. So right now I have $1,800 left. Does that make sense? All right, well, let's move on. On October 15th, there was a second purchase. We bought some more. In fact, we bought 250 units at $20 a unit, so we added $5,000 of value to our inventory. We just debited inventory for $5,000, so if we initially had $1,800 plus $5,000, we're now at $6,800 of goods available for sale. Do we sell any on October 20th? Nope. In fact, we're going to purchase some more. So we had $6,800 worth of inventory, and it's saying that we're going to purchase 150 units at $22 a unit, which is another $3,300. If I add $3,300 to my $6,800, I come up with a total value of goods available for sale of $10,100. So what happens on October 25th? We're going to sell some more. And it says here we're going to sell 300 units. Now, don't be thrown off by the fact that it says we're going to sell 300 units at $30 because that's the sales price. But what we care about right now is what was the cost of those 300 units. Well, remember, it's first in, first out. We know that we've already crossed off this first inventory grouping. Is there anything left of the 600 units at $18? Yes, we have 100 units left, right? So we know we're going to use 100 of those units, and they were $18 a unit. So that's $1,800 worth of cost of goods sold. But this is meant to be a 300 unit sale. Have I sold everything I need to? Nope, only 100 units so far. So how many do I have left to sell? I still have 200 units left to sell. Where am I going to get them from? Well, I've now used up this whole inventory grouping. Do I have anything left of this grouping? Well, yes, I actually have the whole thing. I have all of it right here. I haven't sold that yet. So I can sell up to 250 units at $20. I only need to sell 200, so I can sell 200 units worth $20 each, which is going to be $4,000. That means for this transaction, the total cost of goods sold is $5,800. Now, what is my ending inventory? Well, I know I don't have any of this inventory grouping left. I don't have any of the $18 per unit inventory left. I have 250 minus 200 units left at $20 a unit, which means it's 50 units left at $20 a unit, and that gets me $1,000. And I have all of the 150 units at $22, which gave me a value of $3,300. So those two together, $1,000 plus $3,300 gets me $4,300 left. Now let's look at that all nicely color-coded. We started beginning inventory 300 units at $16 a unit, $4,800 in inventory. Then we added 600 more units at $18. So we had a total of $15,600 in inventory. On the 8th, we made a sale of a total of 800 units. 300 came out of the first in group at $16 a pop, but I still needed 500 more units, so I went into the next group at $18 a pop, and I came up with 4,800 plus 9,000 for my cost of goods sold. Then I had to figure out the inventory balance. I had 0 left of my $16 units, and I had 100 left of my $18 units, so I was left with 1,800 in inventory. I then added the 250 units at $20, and then I added 150 units at $22, so by October 20th, I have $10,100 of goods available for sale. Then I sell 300 of them. Where am I going to go for those 300? Well, notice I had none left of the blue, but I still have 100 left of my purple grouping, so I'm going to sell those, and they're $18 of cost per unit. But I have a 300 unit sale, and so 100 isn't going to quite cut it. I still need 200 units left. Where am I going to go for those? Well, I'm going to go to the red group because that's the next most recent. And that's 200 units at $20, which is another $4,000 of cost of goods sold. Now let's see what I have left. I have none of the blue. I have none of the purple. I have 50 left of the red grouping and 150 left of the green grouping, and ultimately that gets me $4,300 of ending inventory. Now remember, I am going to try to figure out my total COGS by adding them all together. $4,800 and $9,000 from the first sale, $1,800 and $4,000 from the second sale, for a total of $19,600 in COGS. I'm going to have, in terms of ending inventory, it's just whatever I was left with at the end of the last transaction. So if there was $4,300 left after the October 25th sale, then there's $4,300 of ending inventory left at the end of the month. Notice we sum the COGS column. We just grab the ending final inventory from the last transaction for ending inventory.